What, panic selling and falling demand? You won't want to miss this, so stay tuned. Hi, I'm Christopher Marr with Marr Marketing Group, local Orange County realtor, and I've been helping buyers, sellers, and investors for over 30 years. Our videos are based on the Orange County housing market, so if the OC is something that interests you, well then you're in the right place. Many people jumped out of the market because of the crazy competition amongst home buyers, followed by skyrocketing mortgage rates. Now that rates are starting to trend downward and inventory has increased, let us know down in the comments below. What do you think is going to happen in the Orange County housing market? Now let's get into it. The January market data is in, and it shows demand at its lowest level since tracking began in 2004. This calculation is based on new escrows from the prior month. January is historically slow after the holidays, with potential buyers and sellers still shaking off the holiday fog after a festive season filled with, well, many distractions. Market activity typically takes a few weeks to show signs of life. This OC annual housing chart shows a 10-year history that helps put things, well, a little more into perspective with regards to active listing inventory and expected days on market. Now, 2021 and 2022 are obviously exceptions as mortgage rates experience back-to-back record lows to start those years at 2.65% and 3.22%, which continued to fuel an insatiable demand chasing historically low inventory. This year's 6.14% interest rate is the highest start to a year since January 2013. Today's inventory might be the second lowest level to start a year, even beating 2021. But when it's combined with record low demand, the expected market time is no longer at the insane pace of 2021 and 2022. Instead, it's like 2016 through 2018 and 2020 with a market time of 82 days. Now, January's 84 days is really not that alarming. It may not be as slow as 2014, 2015, and 2019, but with the reduced number of buyers actively looking, they are not tripping over themselves to purchase. They're discerning and unwilling to pay above market price, carefully arriving at a purchase price that's more reflective of a home's condition, location, upgrades, amenities, and age. So you're wondering, what's precluding homeowners from listing their homes? It's really not that surprising. They continue to hunker down in their homes, enjoying comfortable equity positions and not willing to move due to the difference between their historically low fixed rate mortgages and today's much higher rates. One homeowner shared, "We purchased before the Great Recession, but chose not to sell when the market was down because we love our home. So price fluctuation really never impacted us." Another homeowner likened her home to stock she owns. "If I'm long-term on a stock, I don't sell it if the stock takes a short-term hit, and the same goes for my home. I would be foolish not to expect market fluctuations, but I control when I sell." She further added, "I don't use my home's equity to fund my lifestyle. That's why I budget and save." Wow. I felt like she dropped the mic when I read that. Good stuff. Hey, we'd really like to hear your thoughts about the market today. So drop us a comment below. We really enjoy reading your feedback. This chart provides a snapshot of today's market measurables with a look back at the expected marketing times just 12 months ago, before the Fed raised rates 7 times to slow inflation and a red-hot housing market. As more homes come on the market, expect demand levels to climb. It will improve over the course of the next few months and will continue to climb until peaking somewhere between the end of March and mid-May. As mortgage rates fall consistently into the 5% range, demand will continue to improve. Some savvy first-time and move-up buyers are negotiating 2-1 and 3-2-1 buy-downs into their purchase contracts, generating immediate savings while locking up properties meeting their longer-term goals and needs. Remember, market traders in 2022 predicted lower rates in 12 to 24 months as inflation indicators reflected positive trends. We are already off the highs of November when rates hit 7.25%. As we look at the luxury market numbers, These homes, which are priced above $2 million, increased from 554 to 579 homes, up 25 homes, or 5%. Luxury demand decreased by 22 pending sales, down 19%, and now sits at 91, its lowest level reading since May of 2022, the initial COVID lockdowns. Luxury marketing times are returning to pre-pandemic levels. It wouldn't make sense to review the market activity and not review the economic indicators that impact mortgage rates and ultimately buyer affordability. CPI, or Consumer Price Index, which is a measure of the average change in a price over time in a fixed market basket of goods and services. As you can see in the chart, December CPI of 6.5% hit its lowest level in 2022 and is down from its June high of 9.1%. It's trended down for the last 6 months of 2022. This is a sign that the Fed's aggressive rate increases in 2022 are having a positive impact. Now, core CPI, which is often referred to as core inflation, excludes energy and food prices because of their volatility. The core CPI is a primary indicator and one that the Feds follow closely. You can see in the chart, core inflation as of December is also at its lowest level in 2022. Wendy Edelberg, Senior Fellow with the Hamilton Project, and Justin Wolfers, Senior Fellow with the University of Michigan, were quoted in this recent article from the Brookings Institution, a public nonprofit on public policy. Wendy Edelberg said, "For the last 3 months, core inflation has risen at a rate of 3.1% at an annualized rate, and that's not all that far from what the Fed would target for that rate." She went on to say, noting that the Fed's target for core CPI is around 2.5%, slightly higher than the Fed's target rate of 2% on an alternative inflation measure. Justin Wolfers said, "We're never allowed to say we've won the war on inflation, but what we do get to say is we feel enormously more relieved today." In this chart, the Fed, or more appropriately, the Federal Open Market Committee, FOMC, raised the federal funds rate in all 7 meetings in 2022. March, 25 basis points, May, 50 basis points, June, July, September, and November, all 75 basis points each. And in December, only 50 basis points, for a total of 4.25%. The Fed's measuring for the Fed funds rate target is still 5 to 5.25%. That said, many traders strongly believe any increase in March will be smaller. There continues to be speculation on whether the Fed will pause or pivot on their messaging in the second half of 2023. One thing you can count on is that the Fed will remain vigilant to avoid any miscues. Now, despite these increases we have seen in the Fed funds rate, mortgage rates have fallen from their November peak of 7.25%, as inflation indicators have trended downward. Rates are still anticipated to finish 2023 in the 5% range. I feel I would be remiss if I didn't address a couple items. Now, with all the talk of recession and inflation, pundits seem to be confusing many with their conflicting views on the start of the recession. We are finding that many first-time and move-up buyers are asking very similar questions. Did the recession start? When might it end? What's the historical impact of recessions on the Southern California housing market? Well, let's agree. We're not going to determine when recessions start or end in this video. That requires a lot of economic modeling. It's important to understand the indicators these pundits refer to in their conversations about a recession. These indicators actually happened in 2022. 2 consecutive quarters of negative real GDP. This occurred in the first half of 2022. An inverted yield curve, showing long-term interest rates falling below short-term interest rates. Economists have interpreted this as a warning sign for a recession in an economy. Rates inverted 3 times in 2022, first starting in April. A Reports on Housing article noted an interesting fact. Did you know that in the last 6 recessions, only 2 negatively impacted housing values here in Southern California, and both were caused by the housing industry? The savings and loan crisis of the 1980s and early 1990s led to a recession. One of the main reasons, unsound real estate lending practices. The Great Recession began in 2007 after the subprime mortgage meltdown, again from unsound real estate lending practices. These unsound lending real estate practices don't exist in our market today due to more than a decade of very stringent lending guidelines. The market data is not saying that prices can't or won't pull back, but that's very different than a market collapse, which fearmongers have chanted. Remember, they also chanted panic selling would happen in the fourth quarter of 2022, which never happened, not even close. We spend a significant amount of time reviewing all market-driven data and historical comparisons so that we can better advise our clients. If you would like to book a strategy call, click the link in the description below. Again, I'm Christopher Marr with Marr Marketing Group, and we'll see you on the next video.